Hey, Tom Hegna here, coming to you live from Flagstaff, Arizona. Let me tell you a little bit about myself. My name is Tom Hegna. I've written 5 books on retirement. I'm originally from a small town in Minnesota, went to college at North Dakota State University on an Army ROTC scholarship. I was commissioned in the military, spent 6 years active duty Army, 16 and a half years Army Reserve. I retired as a lieutenant colonel in 2006. I was basically in the insurance industry for about 30 years. I was an advisor, I was a manager, I was a national marketing manager, and I wound up as a senior executive officer of a Fortune 100 company. I went on my own in 2011, and as I said, I've written 5 books on retirement. I have a PBS TV special, Don't Worry, Retire Happy, that's played in over 80 million homes in the US and Canada. I don't sell any financial products, and I don't get compensated on the sale of any financial products. I typically work with most of the Fortune 500 insurance and investment companies to do 2 very simple things. Number 1, I train financial advisors, and number 2, I do public seminars and public webinars like this. I've done over 5,000 live seminars in all 50 states. What I want to do with you today is share with you really the math and science behind a successful retirement. You know, my first book, Paychecks and Playchecks, I was a reluctant author. I never wanted to write a book. I didn't dream of writing a book. It certainly wasn't on my bucket list. So why to write a book? Well, here's why. Because right now, if you were to talk to 50 different financial advisors and ask this very simple question, how should I retire? Or what should my retirement portfolio look like? You know what you're going to get? You're going to get 50 different opinions of what you ought to do. Well, isn't that interesting? See, retirement's been studied in depth by PhDs all over the world. People like Dr. David Babel of Wharton, Dr. Moshe Milevsky of Toronto, Dr. Menachem Yari of Israel, most recently, Dr. Robert C. Merton, a Nobel Prize winner published in the Harvard Business Review. Well, guess what? I've read their research. And you know what their research says? There are not 50 optimal ways to retire. There's really one optimal way to retire, and that's not my opinion. It's based on mathematical, scientific, and economic facts. Now, notice how I say optimal. I don't say the best because, see, nobody knows what's going to be the best. I mean, if the Dow goes to 100,000, we should all be in the Dow. If oil goes to $10,000 a barrel, we should all be in oil. If gold goes to, $1 million an ounce, we should all be in gold. Nobody knows what's the best. And so what math and science does when there's so many different variables, it looks for the optimal. And the optimal simply means this will be the best more often than anything else will be the best, and it'll never be the worst. So I'm going to share with you the optimal way to retire. Now, I will talk about financial products, but do you know why? It's because math and science literally demands that you put certain products in your portfolio to remove certain risks in retirement. What I want you to understand is that the distribution phase of retirement is very, very different than the accumulation phase of retirement. And if you've been dealing with a stockbroker for the last 30 or 40 years and you think you're just going to cruise on through retirement taking money out of that portfolio, I am here to tell you, you will be sadly disappointed. That is not what a financially successful retirement looks like. A financially successful retirement has 2 very simple components. Component number 1, you want to make sure you have increasing income for the rest of your life. And I'll explain to you in a little while why it needs to be increasing income. And component number 2 is risk management. You've got to take key retirement risks off the table. So what I'm going to show you today is how you can get the most for the least in retirement, because that's really what it's all about. You don't have a chance to go and do it all over again. Now, I can tell you the day I decided to write the book. The day was April 4th of 2011, and I was reading the Wall Street Journal, and the headline reads, Fed's low interest rates crack retirees' nest eggs. And this article was all about a guy by the name of Forrest Yeager, 91 years of age, down in Port Charlotte, Florida, down to his last $45,000. He had it sitting in a CD earning about 1%. He says, I'm not going to make it. I'm having to take money out of my principal, and I'm going to run out of money. And I'm reading this. I want to say, Forrest, did you know that you could walk in almost any insurance company in America today and buy a lifetime income annuity, and the guaranteed payout rate on a 91-year-old is nearly 20%. He could have been guaranteed $9,000 every year for the rest of his life. He would have never run out of money, but Forrest didn't know. There were other people in this article, they had their money in the market and they couldn't even sleep at night because of the volatility of the market. I said, look, I got to write a book. So I wrote a book on how to retire the optimal way, based in math and science, not based on some stockbroker's opinion. And the first chapter is titled, Whatever Happened Happily Ever After. You read those stories to your kids and grandkids. What happens at the end of every story? Everybody magically lives happily ever after. Well, did you know retirement in America used to be just like that? Retirement used to be a promise. You'd work for a company for 30 years. Then what? They'd hold a party 30. Then what? They present you with a gold watch. Then what? They give you a guaranteed paycheck every single month in the form of a pension for the rest of your life. Wow, so that you too could live happily ever after. Hey, what happened to that deal? Less than 9% of Americans have that pension at a time when there's 78 million baby boomers heading straight into retirement, a time when people need guaranteed lifetime income more than ever, and they don't have it. Add to the fact that people are living longer. The average 65-year-old male will live to be age 86. The average 65-year-old female will live to be age 89. But what's the problem with averages? The problem with averages, that has nothing to do with how long you're going to live. See, if you study life expectancy the way I've studied life expectancy, you're going to figure this out real quick. Life expectancy is not an average at all. Life expectancy is simply a midpoint. All life expectancy means is that half of the 65-year-old men will die prior to age 86. What about the other half? They're still alive. Half of the 65-year-old women will die prior to age 89. What about the other half? They're still alive. And here's something that's really crazy. Did you know that married people live longer than single people? I don't know why, but it's a fact. And so if you look at this chart here, his life expectancy is 88, her life expectancy is 89, but for a couple, their life expectancy is age 93. 50% of all 65-year-old couples are going to have somebody live to be age 93. 25% of those couples are going to have somebody live to be 97. And there'll be people on this call who live beyond age 100. So the number one first thing I want to get across is when you are planning for income and retirement, you've got to plan for income to your age 100 and beyond. The other thing is people know how much money they have. I could prove it to you right now. I could have you jot down on a piece of paper how much money have you been able to save from birth until today. And I'll bet everybody on this call could get it within what, 500,000 or 600,000 of the real number. So we all know how much money we have. It's just that most people don't have a good idea of what they can expect from that money. They think, hey, if the market's averaged 12% a year since 1926, I can certainly take out 5 or 6 or 7%. No, you can't, because it's not about how much money you have. It has to do with this order and sequence of returns risks that I'm going to talk about. So I'm going to shake the ladder a little bit. I want to challenge your thinking, because the day you retire and start taking money out of a portfolio, average returns mean nothing. Now, why is that a big deal? Well, because for your whole life as a saver and investor, average returns mean everything. I mean, if you can get 8%, it's better than 6. If you can get 10%, it's better than 8. If you get 12%, it's better than 10. So our entire lives is focused on our average return. And yet the day you retire, you could average 10% a year for the next 22 years, only take out 5% and go dead broke just like that. People don't understand it. And that's called the sequence or order of return. So let me try to explain that. Here you got a guy in 1973. He invested 50% stock, 50% bonds. He had $100,000, and he invested 50% stock, 50% bonds. He averaged 10.1% for the next 22 years, and you can see that he wound up with over $840,000. And it doesn't matter if we ran the numbers backwards from 1995 to 1973. Why? Because he still averaged 10.1%. He still had a lot of money. Okay, and that's the way that most people think the markets work, and that is how it works when you're a saver and an investor. That is not how it works the day you retire. The next slide I'm going to show you is a guy who also had $100,000 in 1973. He also invested 50% stock, 50% bonds. He also averaged 10.1% a year for 22 years. But the next guy retired in 1973, and his broker told me he could take out 5% per year. Now, come on. If you average 10.1% a year for 22 years, you can certainly take out 5% a year, right? Wrong. He's dead broke. He completely ran out of money. And it has everything to do with sequence of returns risk, because what happened in 1973, 74, 75, the market went down, down, down. And if you retire in the first couple of years of your retirement, the market goes down and down, it can cause your portfolio to enter a death spiral it will never come out of. I'll talk a little bit more about it when we get to the rest of the risks. This is another way of showing it to you. And this is going to go against everything you've always been taught. You know how I know? Because it goes against everything I was always taught. I was always taught the older you are, the more conservative you should invest. I was taught that 80-year-olds should invest their money more conservative than 60-year-olds, and 60-year-olds should invest their money more conservative than 40-year-olds. That's what I was taught. I'm sure you were taught that too. That's not what this shows. Both of these portfolios have identical average returns, identical. What's the only difference? The only difference is that the red portfolio lost money early in retirement. It devastated their retirement. The blue portfolio lost money later in life. It had much less of an impact. So if you had to say to me, Tom, when is the riskiest time to invest? I'm going to say it's not when you're 87. It's when you're 57 or 67. See, the riskiest time for you to invest are those years right before or right after retirement. If you want to find a time in your life where you don't want to lose any money, you don't want to lose lose any money right before or right after retirement. Why? Because that can decimate your entire portfolio and it can ruin your entire retirement. So, people in their 50s and 60s really need to look at putting some guarantees in that portfolio, because you don't want to lose money in that box right there. And that's where 78 million baby boomers are right now. The other thing is that inflation can have a dramatic impact on future purchasing power. This is why I said you can't just have income for the rest of your life. You got to figure out how you're going to have increasing income for the rest of your life. And this shows $1,000 of purchasing power at 4% inflation will be cut by more than 50% in 20 years. It'll be cut by more than 2/3 in 30 years. And even if you look at inflation at 2% or 1%, the purchasing power gets cut very significantly. So look, this is where stocks can fit. This is where real estate can fit. You can invest in things that if we get inflation, they will go up. And then there's more money to take out more money. But you can also protect yourself against inflation like I've done. I purchased guaranteed lifetime income that kicks in when I turn age 60. But I bought even more that kicks in when I turn age 65. I bought even more that kicks in when I turn age 70. I bought even more that kicks in when I turn age 75. I am guaranteed to have increasing income for the rest of my life. And you can do that as well. So, look, here are the major risks in retirement. You've got that market risk. We've seen that. There's withdrawal rate risk. There's that order and sequence of returns risk. Let me just spend a little more time on that order and sequence of returns risk. Let me share with you why even really smart people don't get it, all right? They say things like this to me. They say, well, Tom, markets go up and markets go down, but over time they always go up. Well, hey, that's great if you're in your 20s and 30s. You can close your eyes. You dollar cost average in the stock market. You wake up on your 65th birthday, you're rich. It works. It doesn't work when you're in your 50s, 60s, and 70s. But you know why? It is because it is no longer dollar cost averaging. It is now dollar cost ravaging. Let's say you don't believe me. Let's say you're just going to run your portfolio and you're going to take money out of there. Well, you know what? That's going to work as long as the market's going up. But as soon as the market starts going down, guess what you have to do? You have to take out more and more and more. And when the market goes back up, none of that grows back because you just took it out and spent it. And then the market goes down and you got to take out more and more and more. And the market goes back up, none of that grows back because you just took it out and spent it. And all it takes is a couple of those dips early in retirement. And that portfolio can enter a death spiral it will never come out of. Well, then I get people who say this, well, Tom, I don't panic. I don't sell. I just wait it out. It always comes back. Well, isn't that interesting? Are you aware that the Japanese stock market has been down for over 30 years? The European stock market has been down for over 20 years. I'm simply telling you, Americans have no idea how far this market can fall and how long it can stay down. Now, am I saying this is the time it's going to happen? No, probably not. I mean, the Federal Reserve printed trillions of dollars. Congress has pumped trillions of dollars in, but you know what? That's not fairy dust they're sprinkling. Those dollars are going to come out of your IRA and 401k. So another thing that I've been recommending is that people consider moving their IRAs and 401ks to Roth IRAs and consider cash value life insurance, because you want to have some tax-free buckets of money to take money out of when taxes go up. And it's just a matter of time. I mean, this is not even a Republican or a Democrat issue. This is a math problem, okay? We need a math party. We need a party that can add and subtract. So I'm telling you what, regardless of your party, taxes are going to have to go up at some point. It's just math. People are worried about that we're going to have inflation. We printed all this money. I published my economic commentary. You can find it on YouTube. Just Google Tom Hegna economic commentary. I'm one of the only economists in the world for the past 9 years that said interest rates are not going up. Everybody said, oh, they're going up now. I said, no, they're not. They're going up now. No, they're not. They're going up now. No, they're not. All right. We are not facing inflation. We are facing deflation. And, I'm not going to get into the whole economic discussion. You can watch my YouTube videos on it, but it has to do with debt, deleveraging, and demographics. And if you're worried about inflation, here's the cure. Just watch the 30-year government bond. Right now, the 30-year government bond is like at 1.3% or something. If that thing goes up to 3% or 5% or 7%, then you can start worrying about inflation. But right now, the bond market is screaming that interest rates are likely to stay low for literally decades. So the world is more facing deflation risks. There's still 16 or 18 trillion dollars of government bonds around the world paying negative interest rates. You might need long-term care. You might die. There's a lot of risks in retirement. But there is only one number one risk in retirement. So look at that list. Which of those risks is hands down? Nothing's even close. The number one risk in retirement is longevity risk. But why? It's because it's not just a risk. It's a risk multiplier of all the other risks. See, the longer you live, the more likely the market will crash. The longer you live, the more likely you'll take out too much money. The longer you live, the more likely you'll raise your taxes. The longer you live, the more likely you'll see inflation. The longer you live, the more likely you're going to need long-term care. So with the PhDs who study retirement, and they are unanimous in saying this, to retire optimally, you must take longevity risk off the table. In fact, if you get nothing else out of my first 20, 30 minutes, get that. You must take longevity risk off the table. Well, guess what? Stocks can't do that. Bonds can't do that. Real estate can't do it. So what can do it? Well, it's a pretty short list. A lifetime income annuity can do it. A deferred income annuity can do it. Or an income or withdrawal benefit rider from a fixed index, or variable annuity can do it. That is it. What do all those products have in common? One word: annuity. What all the research I can find from the smartest PhDs in the world who study retirement says this: to retire optimally, you must put an annuity into that portfolio. Why? Because only an annuity can take longevity risk off the table. Why? Because only a life insurance company can issue an annuity. Why? Because only a life insurance company sells life insurance to be on the other side of that risk. Hey, let me ask you a simple question. What is the risk to the insurance company when you buy a life insurance policy? What's the risk? That the person dies too soon. They buy $1 million term policy. Next day, bam, they get hit by a bus. The insurance company's out $1 million. The guy died too soon. Hey, what's the risk to an insurance company when somebody buys some guaranteed lifetime income? That they live too long. She's 115 and she won't quit breathing. And every month she's breathing, those checks got to go. Do you understand? Because an insurance company is on both sides of the mortality and longevity risk scale. They're the only ones that can protect you from dying too soon with life insurance or living too long with guaranteed lifetime income. And oh, by the way, that's a mathematical, scientific, and economic fact. See, those are the problems, but let's get into some of the solutions. So look, Paychecks and Playchecks closes with 4 simple steps to a happy and successful retirement. So you might want to jot these down. Step number 1, you want to at least cover your basic living expenses in retirement with guaranteed lifetime income. So you want to find out how much do you need for your housing, your food, your clothing, your cell phone, your internet. You know, if you take trips once a quarter to go see the kids, whatever your normal expenses are, that should be covered with guaranteed lifetime income. Now, there are only 3 sources of guaranteed lifetime income. So the first source is Social Security. Well, Social Security counts because it's a lifetime income annuity. It's a guaranteed paycheck for life. So pensions count because what is a pension? A pension is a lifetime income annuity. It's a guaranteed paycheck for life. But whatever you're short, you know what you're supposed to do? You're supposed to go find an insurance company and buy some form of lifetime income annuity to at least cover those basic living expenses. And I think we've seen why. You know, I say all the anti-annuity dominoes have fallen. Remember, I don't sell any financial products. I don't care if you buy them or not, but I'm going to show you why math and science says you should. You know, I say all the anti-annuity dominoes have fallen. People say, rental, I'll have rental properties. Yeah, how's that working when renters don't have to pay rent and landlords can't evict them? They said, I'll do laddered bonds. How do laddered bonds work when the 10-year treasury is at like 60 basis points? People say, dividend paying stocks is the way to go. Yeah, hundreds of companies have slashed or eliminated their dividends. And then people say, I buy tax-free municipal bonds. Did you read the Barron's report just a few weeks ago that said many of these municipalities are in severe financial shape, and many of them are going to have to default on their bonds because of Corona and all the other things that have been going on. So all the anti-annuity dominoes. So the place the annuity fits is to at least cover your basic living expenses in retirement. Look, you don't have to be worried, is the market down or what's happening to pay your rent or pay your mortgage or buy your food. You've got to have guaranteed income to at least cover those basic living expenses. And here's the reason why. You take 5 key retirement risks off the table when you cover those basic living expenses with guaranteed lifetime income. You take longevity risk off the table. Why? Because that's a guaranteed paycheck no matter how long you live. As long as you're breathing, that check is coming. It takes deflation risk off the table because if you're getting a check and we actually go into a deflationary economy, it's one of the best things to own in a deflationary economy. There's no market risk. There's no withdrawal rate risk. There's no order or sequence of returns risk. You take 5 key risks off the table simply by covering your basic living expenses in retirement with guaranteed lifetime income. Now, I always talk about the magic words of retirement. So people say, well, what is this, the guaranteed lifetime income? What's a lifetime income annuity? I say it's a guaranteed paycheck or a guaranteed playcheck for the rest of your life. Look, you want to know why so many of your friends are miserable in retirement? It's because they got assets and they're losing money in oil. They're losing money in gas. Many of them are losing money in stocks. They're losing money in crypto. They're losing. these people are miserable. Assets make people miserable in retirement. See, what allows you to enjoy your retirement are these guaranteed paychecks and paychecks, because when these checks come rolling in, you know what you better do? You better spend the money, because you know what happens next month? The checks come rolling in. And you better spend the money, because guess what happens next month? The checks come rolling in. And it's the unlimited checks and spending that actually allow you to enjoy your retirement. It's the bottles of wine with your friends. It's the dinners out. It's the travel. See, I don't care how many millions of dollars you got stashed in some account somewhere. If you're just scared to death to do anything with it, and you're living this just in case retirement, you're never going to enjoy your retirement. Remember, you're not getting any younger, and you don't get to take any of it with you. I want you to say that again. You're not getting any younger. You don't get to take any of it with you. You're supposed to spend your money. You're supposed to go out and enjoy yourself. So why should you use a lifetime income annuity? Well, the major reason is because the payout rates are much higher than what you're going to get in almost any type of income producing vehicle. And people say, oh, it sounds too good to be true. It's not too good to be true. Do you know who sets the payout rates on annuities? They're called actuaries. Do you know what actuaries have to study to become actuaries? They have to study math and science. What I'm telling you is that life insurance and annuities are based in math and science. They're not based in opinions. The reason the payout rates are so high is because every check you get from an insurance company is composed of three parts. Part number one is principal. That's the orange box. Anybody can give you principal. Part number two is interest or investment gain. That's a gray box. Anybody can give that to you. But part number three is the secret sauce that you can only get from a life insurance company. You can't get this from stocks or bonds or real estate. And they're called mortality credits. And these mortality credits, you get paid more mortality credits the older you are and the longer you live. And so even if your account totally runs out of money, the paychecks never stop, because these mortality credits guarantee that you will be paid no matter how long you live, no matter what cures they develop. And so some people say, well, gee, with all this medical technology, these companies are going to have to pay so much money, they're all going to go broke. No, they're not. Because remember, yeah, they're going to pay a lot of guaranteed lifetime income, but then they won't be paying death claims if people are living longer. And so because they're on both sides of this risk, they can neutralize mortality and longevity risk to themselves and to you. And it's these mortality credits that are really the secret sauce of guaranteed lifetime income. Now, you're saying, okay, well, what are these mortality credits? Well, let me try to tell you a story. Every year, there were 5 90-year-old ladies who went on vacation. One year, one of them said, hey, let's each put $100 in this box. We'll tape up the box, and next year we go on vacation, we'll bring the box with us, and those of us who are still alive, we'll open the box and we'll split the money. They said, Helen, that is a great idea. So you got 5 90-year-old ladies. They each put $100 in the box. That's $500. They taped it up. What do you think happened the next year? They forgot where they put the box. No, unfortunately, one lady's died. So now 4 ladies split the $500. They each get $125. Now, that was a 25% rate of return in 12 months. I got 2 questions for you. How much of that was invested in the stock market? 0. What interest rate did it earn in that taped up box? 0. How they get paid 25% with no money in the market, no interest rate, is because they got paid mortality credits. So ladies are looking at this. They look at the brokerage account and they say, hey, this is a pretty good deal. I'm going to put it back in the box, tape it back up, and do it again. So they decided to let it ride. The next year, one more lady died. Now 3 ladies split the $500. They each get $167. That was a 67% return in 2 years. No money in the market, no interest rate. Why? Because they got paid mortality credits. Now, I know what some of you are thinking. You're saying, yeah, but Tom, I don't want my money to disappear when I die. You don't have to. You can have the check continue to your spouse. It can continue to your child. It can continue to your grandchild. You decide all of that when you're sitting down with your financial professional. So it's really these mortality credits that are the secret sauce. Now, I know I've got some doubters out there. You don't like annuities. You listen to Ken Fisher. I wrote an article, by the way, why Ken Fisher really loves annuities, and you should too. You can look that one up as well. But I always like to give people a chance to prove me wrong. So I'm going to give you a chance to prove me wrong, and I'll let you call in Susie Orman, Dave Ramsey, and Ken Fisher to help you. And it's going to be a very simple challenge. If I'm wrong, you'll be able to prove me wrong just like that. So here's the challenge. All you have to do is build a portfolio that I can't beat. Oh, he'll never beat this one. We're going to put all the good stocks in there. Yeah, you build that portfolio. You know what I'm going to do? I'm going to reach into your portfolio. I'm going to remove some of your bonds. I'm going to replace it with some guaranteed lifetime income from an annuity. You know what that will do to every single one of your portfolios? Every single one of them. It'll lower the risk and increase returns. Now, that is a very simple challenge. If I am wrong, somebody should be able to prove me wrong just like that. But here's why you can't, and here's why they can't. Inside of a portfolio, the way the guaranteed lifetime income functions, it functions like a AAA rated bond with a CCC rated yield with 0 standard deviation. So let's just say for a minute there wasn't anything as an annuity. The annuities didn't even exist. but there was a AAA rated bond with a triple C rated yield with zero standard deviation, what would happen to your portfolio if you removed your normal ordinary bonds and replaced them with a AAA rated bond with a triple C rated yield with zero standard deviation? It would immediately lower the risk and increase the returns. Tommy's not making this stuff up. These are mathematical, scientific, and economic facts. Now, math and science is very important to me. I travel the world teaching people how to retire. It better be right. I mean, think about it. I'm on PBS in 80 million homes. Golly, I sure hope it's correct. But for you, there's something more important than math and science. I call it the happy factor. So let me ask you a very simple question. When you retire, do you want to be happy or unhappy? Well, bet you said happy. Well, see, the Wall Street Journal discovered the secret to a happier retirement is friends, neighbors, and a fixed annuity. See, what the Wall Street Journal found is that the happiest people in retirement are people surrounded by their friends, surrounded by their families, who have guaranteed paychecks every single month. In fact, let me ask you a question. Who are your happiest retired friends? I bet it's your retired military, retired government, retired teacher, retired firefighter. It's people with pensions. See, study after study after study showing people with pensions are much happier in retirement than people who don't have pensions. Do you understand happiness in retirement is tied to almost 100% to guaranteed lifetime income, not assets? Who are the most miserable people you know? They're loaded. They got assets out the wazoo, but they're losing money in oil. They're losing money in gas. They're losing money in stocks. These people are miserable. Assets make people miserable in retirement. What makes people happy is guaranteed lifetime income. Look, Time Magazine found the same thing in Great Britain. Lifetime income stream key to retirement happiness. A new study in the land of grumps reveals that retirees with a guaranteed lifetime income stream can find true happiness. And you know, if you still don't believe me, you can Google Towers Watson. All right. They're not even in the insurance industry. They wrote a whole white paper on annuities and retirement happiness. You know what they found? They found that all retirees were happier if they had guaranteed lifetime income. So let me pause for a moment. I think I've proven to you mathematically and scientifically your portfolio will do better if you add a little guaranteed lifetime income. I hope I've shown you you're likely to be happier if you add a little guaranteed lifetime income. Now you know what the research shows? You're likely to live longer as well. Look, some of you follow me on Facebook and LinkedIn, and if you don't, you sure can. I post a lot of neat stuff. I recently posted a Freakonomics study. It's actually a University of Chicago study. Freakonomics picked up on and pushed it out through social media. It was a University of Chicago study that studied people who bought lifetime income annuities versus people who didn't. You know, they found the people that bought the guaranteed income annuities lived longer than the people that didn't. Here's what the research shows. Research shows that people who buy annuities tend to live longer, and not just because of the kind of people that have the money to buy annuities to start with. It's apparently that little extra incentive of the annuity payout that keeps people going. The best article I've read was published 2 years ago in the Journal for Financial Service Professionals. It was written by attorney Patrick Tricker. The title of the article was Annuities and Moral Hazard. Can longevity insurance increase longevity? Here's what he found. In the United States, a 65-year-old male who purchases a life annuity can expect to live about 20% longer than a 65-year-old male who does not. And the whole rest of the article explained why people with guaranteed income tend to live longer. Really dumb, stupid things like they don't have as much stress. They don't worry. Market's down 40%. They go play another 18 holes of golf with their buddy. And because they're being paid to live, guess what? They live a little different. They watch what they eat. They exercise a little more. They go see the doctor if they're not feeling well. And all these little dumb things cause them to tend to live longer. Now, I said this is new research. There's nothing new about this. Many of you had to read a book in high school or college. It was called Sense and Sensibility. It was written by Jane Austen in 1811. See, annuities have been around for thousands of years. The Roman Empire issued annuities. But does anybody remember what Jane Austen wrote about annuities back in 1811? Well, let me refresh your memory from chapter 2. If you observe, people always live forever when there's an annuity to pay paid to them. The annuity is a very serious business. It comes over and over every year, and there is no getting rid of it. She wrote that in 1811. Step number 2, you want to optimize the rest of your portfolio to protect yourself against inflation. So the rest of your money, that's the money that can go into stocks, it can go into real estate, it can go into any of these other investments that can protect yourself against inflation, or you can do what I've done, and that is ladder your purchases of income annuities so that you have guaranteed increasing income for the rest of your life. But see, this is where those other products fit. They do not fit to cover your basic living expenses. And as I said, I think we've seen why. Step number 3, you must have a plan for long-term care. No retirement plan is complete without a plan for long-term care. You know, in Paychecks and Playchecks, I got a chapter on long-term care. You know what it's called? It's called What's Your Plan? What's your plan? Because if you've ever heard me speak before, you know I brag about my plan. What's my plan? I never have to go to a nursing home ever. I get to stay in my house till the day I die. The nurse has come to me. You know why? Because I got a plan. I've got long-term care insurance with home health care. I get to stay in my house. So when people say, I don't want that nursing home insurance, my answer is exactly, this is anti-nursing home insurance. This is stay-at-home insurance. This is stay-in-control insurance. But then people say, well, Tom, long-term care insurance is just too expensive. Here's what I say. If you think long-term care insurance is expensive, you ought to try not having it. Look, I made my parents buy long-term care insurance 16 years ago. They didn't want to. It's too expensive. We'll never need it. It's an insurance company rip-off. My dad said all those words to me. I made them buy it. They were both in assisted living, $10,000 a month. $10,000 a month. Do you understand there were years my dad never made $10,000 a year? $10,000 a month. I can't imagine their retirement if they didn't have those policies. Look, the odds of you needing your homeowner's insurance between now and the day you die are about 3 out of 100. The odds of you needing your automobile insurance between now and the day you die are about 18 out of 100. But the odds of you needing long-term care between now and the day you die is about 72 out of 100. So you've got homeowner's insurance, you got automobile insurance, but you're going to let this one go. This is the one that really needs to be protected. You can think you got it all. Oh, I'm set. I got my stocks. I got my bonds. I got my life insurance. Got everything. Yeah. An unplanned long-term care event can literally wipe you out. So just think of a plan for long-term care as a shield. It's a shield around all your assets and income that protect it so that you get to spend that money the way you want to instead of the way that you're going to have to if you don't have a plan for long-term care. And step number 4, the most efficient way to pass wealth to children, grandchildren, and charities is with permanent life insurance. Now, I know there are people who don't like permanent life insurance, but let me use me as an example. Do you know why so many people are miserable in retirement? Because in the back of their mind, they think they got to leave their kids some money. Oh, we got to leave some money to Johnny and Susie. We got to leave some money to Johnny and Susie. So they deny themselves retirement to leave money to their kids. You know what I tell people? Don't do that. You're not supposed to leave any money to your kids. You're supposed to spend every last nickel you got. The last check you ought to write ought to go to the undertaker, and that baby ought to bounce, all right? I want you to spend your money. I want you to leave them life insurance. So again, let me use me as an example. We got 4 kids. So one day we're sitting around saying, hey, how much should we leave the kids? My wife said, I don't know. What do you think? I said, well, if we bought a $1 million second to die life insurance policy, name the 4 kids as beneficiary, when we're both gone, they'll get $1 million tax-free. I mean, that's $250,000 a piece tax-free. Let's start there. So we bought a $1 million second to die life insurance policy, name the 4 kids as beneficiary. That policy is completely paid up. Do you know what the total cost of that $1 million policy was? $150,000. So now think about that. For 15 cents on the dollar, we transfer $1 million tax-free to our kids. Hey, who gets to spend the rest of the money? We do. I want you to spend your money. I want you to leave your kids life insurance because you can do that for pennies on the dollar. It's all about how do you get the most for the least. See, most people aren't overspending out there. Most people are underspending. They don't touch their money just in case. Oh, the market's so volatile. Interest rates are so low. So they're living what I call a just in case retirement. And I said, wait a minute. You told me when you retired, you're going to join the country club. You're going to buy a new boat. You're going to go on a cruise. Have you done that yet? You know what these people say? No, we haven't done that yet. Why? Because just in case interest rates are so low, market's so volatile. So they don't touch their money. They don't touch their money. They don't touch their money. Then they die. What happens to money? Goes to kids. Well, the kids do with it. They join the country club. They buy a new boat. They go see the world. Look, I want to make something very clear today. I want you to join the country club. I want you to see the world. I do not want you to live that just in case retirement. And if you follow these simple steps, I can help you avoid living that just in case retirement. Now, I say in my seminars, I was going to talk to you a little bit more about your kids, but the more of these webinars I do, I find out a whole bunch of people don't even like their kids anymore. So I go straight to the grandchildren because I know you still love them. And I'm going to tell you, don't leave your grandchildren any money either. And I'm going to share with you why. Here's Annie. Annie has $100,000 sitting down in the bank, is not doing much. She says, Tom, I don't need this money. This is my just in case money. I name my 6 grandchildren as beneficiary. And when I die, they're each going to get a little over $16,000. Well, that's a nice grandma. But if that's her just in case money, why did she put it in the bank? Why didn't she put it in a life insurance policy? Most of these senior policies have full money back guarantee, so she could get the money out if she needs it. But when she dies, each grandchild will get $36,000 instead of $16,000. See, don't leave your grandchildren money. Leave them life insurance because you can leave them so much more. What about charitable giving? Here's Al and Helen. They're very generous people. They tithe to their church. They give to their university. They saved up $50,000 they want to give to charity. But when they started talking about it, they each want to give $50,000. Well, how do you give $100,000 to charity? If all you got is $50,000, you put the $50,000 in a life insurance policy, it immediately creates $100,000 or more gifting power. You want to leave more to charity? Don't leave them money, leave them life insurance, because you can leave them so much more. What about protecting Social Security benefits? Here, the husband gets $2,100 a month. The wife gets $1,100 a month. What happens when he dies? Well, she gets his. What happens to hers? It's gone. So her income goes down. What happens to her taxes? They were filing joint. Now she has to file single. So her income goes down. Her taxes go up. What could have protected her from this? Life insurance. And just so you know, people over the age of 60 buy more life insurance than people under the age of 60. So don't be thinking you're too over life insurance. You're not. If you have any money that you want to go to your spouse, your children, your grandchildren, or charities, the most efficient way to pass that wealth is with life insurance. So look, I can't tell you if the market's going to go up or if the market's going to go down. I don't know. Are we going to have inflation or are we going to have deflation? I don't know, but I do know this. If you cover your basic living expenses with guaranteed lifetime income, if you optimize the rest of your portfolio to protect yourself against inflation, if you have a plan for long-term care and you use life insurance as the most efficient way to pass your wealth to your children, grandchildren, and charities, I do know this. Each and every one of you can have a happy and successful retirement that is based in math and science, not based on some stockbroker's opinion. Now, people say that knowledge is power. That's not really true. Applied knowledge is power. You see, if you don't do anything with what I just covered, it's going to do nothing for you. So I would encourage you to click on that button on the right. You're going to be connected to a financial advisor who can help answer your questions. It's a no obligation appointment. So just click on that box to the right, and I think it's so important to work with a financial professional. Okay, you don't do your own dental work in your garage with your drill set, and I don't think you have to be doing your own retirement planning either. I use financial professionals as well. I mean, I know this stuff inside and out, but I can't know which product has the latest features and benefits and all of that. I need a financial professional for that, and if I need one for that, I know you do as well. So again, just click on that button to the right and take some action. And I want you to retire happy and successful. Remember, I don't sell any financial products whatsoever. I am here to try to educate you and help you and put you on the right path, and your financial advisor can take it from here. So just click on that button on the right, and thank you very much for attending.